This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Dennis Prager here, and I'd like to talk to you about Jason Hartman. Now, they conduct educational events with new techniques for making money. Now, if you and your properties qualify, it is a tremendous opportunity to reduce your tax liability. Visit jasonhartman.com. That's jasonhartman.com. You'll be glad you did, and tell them Dennis Prager sent you.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
It's Jason Hartman, and this is 1766. There are a few important issues to discover, and it'll be very fast. We'll get to our guest today, which is my buddy Bronson Hill. He's a fund manager. He's got some interesting insights on the economy, on this crazy inflation we're all experiencing. All right, so let's get into it. Take a look at this. We've been talking about it for a long time. I've been predicting it for many years, and here it is. Now, of course, we know inflation is reaching scary historic levels. However, what we have to realize when we look at inflation through time, and we ask what my listeners call the Jason Hartman question, which is, compared to what? Right? The compared to what question. The only way we can really understand something is with context. And the compared to what question brings us context, doesn't it? It gives us a backdrop to understand something really, really well. So when we look at this inflation chart, what we have to realize is that progressively, the inflation numbers we get from the government have been more and more manipulated over the last several decades. Now, this chart is only the recent few years. Well, really recent couple of years, okay? And so you see how absolutely staggering this is. Of course, this is the CPI, the Consumer Price Index, highly manipulated by weighting, substitution, and hedonic indexing. Remember, those are the three major ways the government is lying to all of us about the inflation numbers. But if you look at it here, just checking out the chart, you see that, this 3-year average is 3%. The Fed has announced many times that their target rate, until recently when they said, we don't care about inflation anymore, Jerome Powell just says, look, inflation doesn't matter. That's what he told us first. Well, first he told us it wasn't going to happen. And then when that prediction was wrong, he basically said, it doesn't matter. And it's not a concern. And then he said, it's transitory. It's just a temporary deal. It's no big thing, nothing to worry about. And the liar Janet Yellen has echoed those sentiments pretty well. But the one thing I will say I like about Jerome Powell is at least he doesn't talk in hieroglyphic code like Alan Greenspan, his predecessor from many years ago did. And this genie is not easy to put back in the bottle, is it? No, it's not. So, they've announced many times over the years that their target inflation rate is 2%. Well, why do they want this 2% rate? Because there's something I've taught you about over the years called the Phillips Curve. And the Phillips Curve is what the economists try to target as this relationship between inflation on one hand and employment or unemployment on the other hand. And they feel that if they keep inflation at this 2% target number, the employment rate will be very high, the unemployment rate will be very low, and that'll be a good thing. Now, I wonder why we need any inflation at all. And, there are some reasonable arguments for a low, moderate rate of inflation related to GDP growth If the gross domestic product of the company or the country is growing, then it's fair to have some inflation along with economic growth, as long as it's proportionate to economic growth. That's an argument. I think it's somewhat reasonable. I don't personally agree with it completely, but I'll hear it. It's not outlandish. And then the other one is that the rate of inflation should be commensurate with population growth, right? And GDP growth with population growth as well, right? Because that means the standard of living kind of generally, it's a roundabout way to come at it. But if you look at the output of the economy, the GDP, which by the way, is a highly manipulated number as well, and it includes all sorts of government make-work projects and entitlements that shouldn't be included in GDP, in my opinion, but everything's a lie, everything's a scam, and everything's manipulated nowadays. So all we can do is use these things as baseline comparisons, as long as they're not changed, and reference points, just knowing that they are highly manipulated, whether they be the unemployment rate, the gross domestic product, and the consumer price index, and a million other things that come from our great government. Okay, but the Phillips curve, this target rate of inflation, what you see right now, though, is that the official rate is dramatically higher than their former target rate of 2%. In fact, it's more than triple that amount at 6.2%. Well, what does this mean? It means that people are becoming poorer and poorer unless they have a lot of good long-term fixed rate debt against assets which are generally indexed to inflation. Now, as you know, I believe income property is the most historically proven asset class in the entire world. And this asset class is the most debt-friendly asset class in America. It is the most tax-favored asset class in America. And by the way, we've talked on past shows about how taxes and inflation are such a scam in the way they work together. Because think about it, when everything is inflated, including your income, which hopefully keeps pace or better yet, exceeds the rate of real inflation, or at least the official rate of inflation, which is the manipulated number from the CPI, the Consumer Price Index. But if it does, and they say, well, we're not going to raise taxes, right? We're going to keep taxes right where they are. Think back to George Bush Sr., the first Bush presidency, when he said, read my lips, no new taxes. Now, he broke that promise because he caved into the stupid Democrats, right? But either way, hey, it was his promise, but he caved in. And this is the problem, that the president doesn't have a line item veto. And so we have pork barrel legislation, and it's a scam. Everything is we live in a world where just everything has become a scam, whether it be the university debt enslavement complex scam, the privatized prison scam where they imprison people for profit rather than for committing crimes against society, right? Everything has just become a total epic scam. It's pretty discouraging, I must tell you. But anyway, we've got to protect ourselves from these scams. And so think about the way inflation and taxation work together, right? Now, inflation is a insidious hidden tax. And if you've been listening to me and following my work for a while, you already know that. But what if they don't raise taxes, but everything is inflating and it pushes you into the next tax bracket where you pay a higher tax rate? Well, that's a tax increase, right? But it's one that isn't shown on the books anywhere, because it's this hidden little, inflation is a liar and a thief. It's this hidden tax increase. So that happens. A lot of things happen. But hey, let's talk about it as it relates to real estate investors before we get to our guest today. All right, look at this slide. So this is the Burns Single Family Rent Index. And, we've had John Burns on the show several times over the years, and I just wanted to share this from his newsletter. It's really interesting. Now, remember, this is looking at a lot of markets nationwide, and what is very telling that probably no one sees when they look at this except yours truly. But thankfully, I saw it, and I want to share it with you. I'm going to let you in on the secret here that probably nobody noticed. Okay, the legend here says September 20 year-over-year rent growth percentage. Now, these rents have gone up way, way more since then, right? That's not exactly a sophisticated way to say it. They've gone up way, way more. Okay, it's like more better. Okay, forgive me for my lack of sophistication here early in the morning, but they've gone up way more. Yeah, way more, dude. They've gone up a whole bunch. Okay, they've gone up a lot more since this index time frame. But I want to show you this because it's so telling. What is the thing that nobody would see here? When you look at the legend, the green means increases greater than 5%, and the light green is 4 to 5%. The sort of yellow color, I guess, is 3 to 4%. The orange is 2 to 3%, and the red is 0 to 2%. Now, I would guess that maybe even in some of these areas, rents have gone down slightly. It's possible, but who cares, right? So notice where the red dots are. I want you to notice that, right? My shirt is red. The dots are red. Notice where the red dots are. Okay. They are in cyclical markets. Remember, I've taught you about how there are 3 kinds of markets worldwide. You can categorize all real estate markets into one of 3 general types: linear markets, cyclical markets, and hybrid markets. And the cyclical markets, the markets we don't recommend, have never recommended, there's a lot of red dots on those. And if they're not red dots, they're orange dots. And if they're not orange dots, well, they might be kind of yellow, okay? But notice where the highest rent increases are, where you see green or light green in more linear markets. Now, this is not 100% true, but generally, if you want to sort of get the vibe of things, you see that some of the best performing markets are these linear markets that we have recommended for a long time. Look at Memphis. That is a solid green dot. Now, I've owned several properties in Memphis. We've helped lots of investors invest in Memphis. Birmingham, same story. Atlanta, same story. These are all markets that I've been very active in and I've been recommending for many years. Kansas City, same story. Okay. Now, Minneapolis, we have never recommended. One of the problems with Minneapolis is that you've got a very left-wing political situation, landlord unfriendly, and we want to be in landlord-friendly markets that are friendly to our cause as landlords. And yeah, so anyway, it's just an interesting thing to look at. Okay, I've got to wrap this up, but I want to show you one more thing before I go. This shows you a bar graph, and it shows you demand for single-family rental homes remains robust according to the index. U.S. single-family rents accelerated 3.8% year over year in September. Now, remember, this is already out of date, okay? But it's still interesting to look at because history gives us context, and we've got to have context. And anyway, it goes on. But I want you to notice something here, and just notice this. It's kind of important to notice this. Notice that sometimes in recessionary periods, and again, this is nationwide, so you really got to look at this market by market because all real estate is local. But in some recessionary periods, I want you to see that rent holds up very, very well. The last big recessionary period we had, though, that was true in our markets largely, but it wasn't true nationwide. Why was that? Well, blame the central planners and the government bureaucrats for getting involved. Because when they got involved, what did they do? They interfered in the market, and it was a political year, and they told everybody, the election speech was, we got to keep everybody in their house. Never mind whether or not the people could afford the house or not. That wasn't the issue. We got to keep everybody in their house. So government interference distorts markets, and it suppresses market activity that should happen in a free market. So anyway, I don't have time to go into this too deeply today. We got to get to our guest. So let's roll over that. Reach out to us if you need us. We're happy to help you. Free consultation, portfolio makeover, portfolio review, jasonhartman.com worldwide. or in the United States, 1-800-HARTMAN. Thanks for listening. We're going to go to our guest, my buddy Bronson Hill. It is my pleasure to welcome my friend Bronson Hill. He is an apartment syndicator. He's got about 1,400 units under his belt now. He's the founder of Bronson Equity and a very knowledgeable guy when it comes to the economy, the market, and that all-important question of what's next. Bronson, welcome.
Awesome, Jason. Really happy to be here with you. And I actually started listening to your podcast, I think a little over 10 years ago. So I know you've been doing this for a really long time, and I've just really appreciated the value over the years you brought.
Now I know why you're so smart.
I listen to smart people.
You've been listening to my podcast for 10 years.
Exactly.
Good stuff. Good stuff. Well, hey, it's good to have you. So, Bronson, what is next? Maybe we'll just kind of start with that. That's the question everybody always wants the answer to. And of course, hey, nobody has a crystal ball, but what does yours say? Is it cloudy and murky, or do you see crystal clear what is coming next?
Well, it's interesting, Jason. You and I, we have some pretty smart friends between, George Gammon and some of the different folks that we follow and we hang out with, and we do our own research as well. I think there are really trends that are moving both directions, right? You have inflationary trends such as, so much money printing, trillions of dollars being printed, 40% of all of the currency that has, is in existence now is printed in the last 18 months. You have a lot of inflationary type of stuff when you print that much. Deflationary, I think on the other hand, you do have some trends kind of moving that direction. So I think it's kind of a combination of both, where I think that you're going to get, the Fed is looking at tightening up rates. I personally believe that will affect particularly single family. I think it could potentially drop in certain markets, some of the value of some single family house prices, I think in general. But I think the long term, as our friend George Gammon says, is really inflationary. So having loans on these single family assets or even multifamily like what we do for the long term is actually that becomes the asset, right? Because you're borrowing at such a low rate and you're able to basically going into a time of inflation, you're able to hold it and just really take that spread. So over time, those debts, as you talk about the inflation, and I don't know what the term is, inflation produced debt destruction.
Inflation-induced debt destruction.
It sounds like a disorder you have when your stomach's not feeling well or something, some destruction. Maybe
well,
not.
You know what? It gives a lot of people stomach upset if they don't take advantage of it.
Yeah,
So
exactly.
It's the remedy for inflation. It's like ROLAIDS, Rolaids, right? For acid
Exactly.
indigestion, right?
And I think that's what we're all looking for. Right? We're all looking for that Rolaids that helps us to sleep well at night and know that we're going to be okay. And I think that really when it comes down to it, people are not really asking it now in the mainstream. The inflation is not really, it's starting to become a hot topic, but not really. People don't really believe it's there. The Fed is still saying it's transitory. And I think as long as people believe it, then it continues to perpetuate the narrative. But something is going to happen in the next year, 2 years. We don't know exactly when. There could be a major stock market crash. There could be some sort of real estate correction or something. And all of a sudden, people will start saying, where do I put my cash? Where do I put money? Because it's worth less every year. So one thing I know you and I both talk about is gold. Is just there was a time when the Fed the U.S. went off the gold standard in the 70s, and in 1974 it became legal to own gold again. A lot of Americans don't know that it was actually illegal to own gold for decades. But in 1974,
except as jewelry, you couldn't own gold bars. But yeah.
Right. So 1974 to 1980, I might get this a little wrong, but it was around a 20x increase in the value of gold. And what happened is people just started saying, hey, real estate is not, it's coming down. Things are costing more. Inflation is completely undeniable. And so people start looking for a store of wealth. So it's not that that's the only place to put money, but I do think that there could be a shift where once we get into a high inflationary environment where everybody, is acknowledging it, and we start to have some assets start to have some movement, as particularly on the downside, I think it's going to lead to a lot of uncertainty and a lot of fear.
Yeah, so interesting stuff. And I agree with you for the most part. I do think some of these high price cyclical real estate markets are way into bubble territory. But again, when we look at compared to which we've done before when you've had me on your shows, it still looks pretty cheap in a lot of ways and in a lot of comparisons. I guess it's kind of anybody's guess as to that because there's so many unknowns. I mean, look, if the Fed really does any major tapering, that is certainly going to cool the economy and the markets in any and every asset class, of course. But do you think they'll do that? I mean, it just seems like there is no political will, Bronson, for any kind of discomfort. It's just like, keep the party going. Where's another punch bowl? Bring it out. Let everyone get totally drunk. We'll worry about the hangover in 20 years. I don't know. They're just, nobody's putting the brakes on anywhere you look.
Yeah, it's a really good point. I think, if you study history, which I know you do as well, and I'm sure a lot of your listeners, that there was a figure, in the 70s and 80s, Paul Volcker, who really had the political will to really make the hard choice.
I was just going to say, is there another Volcker? Go ahead.
And we've talked about that, right? There's no Paul Volcker out there saying, Jerome Powell is not he's nobody. I don't see anybody who's going to do that. Yeah. So I think what happens is the Fed has used all their tools to try to continue to stimulate the economy, to throw things at it, to not feel the pain of COVID. And there's actually a really interesting book called Mastering the Market Cycle by a guy named Howard Marks, who is the head of Oak Tree Capital, manages billions and billions. He talks about a pendulum, right? So this pendulum has swung, and the federal government is doing everything they possibly can to get it to move more and more and more. And what happens, he says, is the further the pendulum moves to one side, the further it has to come back to go the other way. So at some point, what that means is that, recession, there could be, rate things. I think when the Fed actually does tighten is when people start saying it is really uncomfortable. We're getting to a place where things are getting to be unaffordable. Things are going to be really expensive, and people are feeling that. But I think once it gets above undeniably, consistently above 10 or 15%, then people start saying, hey, these guys are lying to us. Something's not working here, and they're going to have to. Because if they don't, then we go completely down the road of hyperinflation, which could happen. I don't know, if it's going to happen. I think, from some people, they really think you can print money and you can just solve every problem by printing more money. And we're seeing that with all the stimmy checks and it's crazy. But so it's unclear.
I got a present for you. I want to give you 100 trillion Zimbabwe dollars. Okay.
I'll take it. I have one of those too, right over here in the
Actually,
room,
maybe I'll give you 20 trillion more. So you got 120 trillion.
Yeah.
Right? Yeah.
I'll take it.
And I'll keep a few for myself. You cannot solve every problem by printing money. That's just kicking the can down the road. But it's so unfair and unequal the way it makes the wealth distribution occur. I was talking today on my podcast about gas prices. And I filled up my car over the weekend. I think it was $62 or something. It was over $60. When I first got that car during the end of Trump's term, it was $35 to fill that tank. It's the same tank. I don't go any further. Okay. I simply pay more. That's it. Most low-income people are commuting to their low-income jobs, and they're commuting from a low-priced real estate market to a higher-priced market where people will hire them to be their gardener, their housekeeper, the chef in a restaurant, whatever it is, right? And man, if you're on a limited income, those gas prices really affect you if you commute. I mean, that's a big deal. Suddenly you're spending, $300 a month more and getting nothing else for it. And that's a big deal. All the people on the left who say they're trying to help these people, they just do the complete opposite. It's a total wealth transfer, isn't it?
Yeah, it really is. It's interesting. I think there is some well-intentioned, stuff from the left, but I think a lot of people a lot of politicians really just don't understand. When you print lots of money and you give it out to people, you're actually hurting the very people you're trying to help because they don't own any assets. If you and I own assets, so we can ride that out. We'll ride out inflation just fine. But this is also why around the world you'll see just riots and all kinds of things around the Great Recession, and even it's starting to happen more in different countries where people are getting more upset because they're just saying the cost of everything is going up. So I think when that kind of distaste for inflation goes up and people start saying, hey, how much money have we printed here? What's actually going on? Why is everything costing more? Well, when you raise minimum wage, and you keep giving out, for me, being a real estate investor, it's so inefficient the way the government works. I make enough money to not receive, money, $250 a month for my daughter who's 8 years old, but I get those, right? Because even though I write off money with taxes and my income is reduced lower to zero, it's a very inefficient way of providing people resources. So yeah, it's unfortunate.
Right, but you're almost making the argument for what I think is coming, and that's universal basic income, because then it would be more even, right? Everybody would just get it, and you'd be done with that whole discussion, which I don't know. I think it's just inevitable. It's going to happen. What do you think about the issue of automation and robotics? And I don't just mean robots that physically do things, of course. I mean AI, I mean software that does things, and combine that with this talk of the Great Reset, the sharing economy. The world is really changing pretty quickly, isn't it?
Yeah. So you're
significantly.
It's interesting. There was a book that came out. I don't recall the name of the book, but it was back in the 70s or 80s. It basically said with the advances in technology that, in 10, 20 years, we'd just be sitting around because we have all this time of leisure. We don't have to do any robots would do everything for us. And of course, what are we now? We're busier than ever. We're on our, devices more than ever. We're doing more than ever. I do think there are certain jobs that are really at risk. Obviously, if you're a truck driver, that could be automated. There's a lot of things in fast food, other areas that can be automated, warehouses. But I do think things that have to do with working with people. My background is actually as a medical consultant working in sales, working with physicians on heart surgery. And as much as stuff became automated, I saw even that role becoming more and more important to have in-person people, rubbing shoulders. And it's not just an email or a phone call or some sort of automated thing. People are looking for ways to connect. So I do think that the more we automate, the more people long for human connection. And it's interesting, the more we are, especially children and young adults are more on media and stuff, they have less of these soft skills to actually be able to have a conversation and be able to relate. So if anybody has any kids, it's like, I think STEM stuff is great, but I think that stuff is actually more at risk, having just the sciences and the engineering and all this stuff that's a little more technical, but having the soft skills and the business learning and other things that you don't learn in school that, Robert Kiyosaki talks about, right? The idea of actually learning about money and how it works and learning how to actually have a business. So I think there's always going to be opportunity. I think it is changing, though. I mean, that's the creative destruction we talk about with capitalism, right? It's continually changing. And I do think that there are a lot of, kind of going back to your question about the Great Reset, is there are a lot of people that are really trying to significantly change our entire culture and our entire world. And COVID is a great reason to do that. And so the narrative keeps changing. It's around vaccines, around different forms of control. I live in Los Angeles, where now within a month, you won't be able to go in the city of Los Angeles, go to a restaurant without showing or a gym without showing your vaccination card, or you'll be denied. You can't go there anymore. And it's crazy.
Welcome to the witch hunt. Welcome to medical apartheid. No matter where you fall on the spectrum of your pro-vax, whatever, it doesn't matter. The point is that this is happening. And I never thought we'd see this kind of apartheid in my life. This is just insane. All those who say equality and egalitarianism, it's like the exact opposite. It's just amazing.
Well, it's crazy. There was an article I just read. It was in Fox Business, and it was just talking about one of the administration, or was it either Biden or one in the administration, was saying that this inflation is actually caused, through people not being vaccinated. And the only way we will stop inflation is when you have 100% vaccination in the world. And I was just shocked.
What does that have to do with inflation?
I was just totally shocked. I was like, this is how clueless a lot of our political elites are. They have no idea. Those things aren't even related, but yet you're making it all. And so the narrative keeps changing, right? And again, we don't have to get too political, but it is really a loss of freedom, and it's a loss of a lot of things in I'm curious to see, actually, with children now, they're asking, actually in California, children as young as 5 years old, they're saying once the FDA approves, you have to get your children vaccinated that are over 5 years old to even take them to school. And even teachers, they're saying you have to require that. So what happens when teachers don't get vaccinated, which some are not wanting to?
Here's one of the predictions I made around a year ago, March. Okay, I made a lot of my predictions in February before anybody was doing it, but one that I noticed a little bit later, about a month after, is that real estate values are largely based on school districts, because we have this stupid thing in this country of public education, which is stupid on its face, right? But, let's not bother to go there. I mean, I don't deny that the government should offer maybe some basic education. Okay, I'm not totally against that, but just the way it's set up, and it's run by the NEA, the National Extortion Association, otherwise known as the National Education Association. It's just like everything, it's become a complete scam. But if real estate prices are influenced by the quality of school districts, what happens when everybody's doing remote learning and where geography becomes less meaningful? Now, geography is always meaningful, but like I've been saying for at least since 2012, geography is less meaningful than it's ever been in human history. Mm-hmm. Now, it's meaningful, but it's less meaningful than ever. Okay. So what happens to the disruption in real estate values? What happens to the disruption in city real estate values? I'd like you to maybe talk about that with some of the apartment complexes you look at, some of the deals you do, and also, if you know it, and you may not know this much granular data, but is there anything happening to the makeup of your tenants in your buildings? Are they changing at all? Are they saying different things to your leasing staff, et cetera? So both of those questions.
Yeah, so it's a great question. I mean, we're seeing now more than ever that you can work remotely, your kids can do school remotely, you can live wherever. People are going international and doing that. And we're seeing people move from California to places like where you're at in Florida or Texas or Alabama or Arkansas. And we're seeing it because it's cheaper to live, the weather's better, there's more jobs, there are businesses moving there as well. And so, it is getting easier than ever to be able to move. The other thing that we watch and kind of where we buy apartments, so we don't buy in New York City or even anything in California. We pretty much are buying Texas to Florida. We love these southern regions because of the population growth, the job growth, and income growth. And there's reasons for that. Like I mentioned, COVID. Another one is retirees. I mean, there's so many retirees that are getting to a place where they're wanting to move, and they're looking for cheaper places. They're also looking for places that they can still have all the things they want. So we like Atlanta, we like Jacksonville. We've done a couple deals in Jacksonville, and basically areas where we see those metrics, we're going to see people move, and we're going to see people support them. So for every retiree that moves, I think about this as well. You're going to have people that have to go to do healthcare and car services and retail and clean the house and other things like that. So we see that type of thing. We see a lot of migration, and it is getting easier and easier. Another trend too, beyond kind of what we do in multifamily, we're seeing is people going to really beautiful tertiary markets. So places such as outside of Boise, Idaho, Park City, Utah. Some of these areas that are just really pretty that people can, live in the Tahoe area. And some of those markets have just exploded because now you can be close enough to wherever you are, but you can work remotely and your kids can do stuff remotely. So we're seeing that. I have a lot of friends that have moved for various reasons.
Are the tenants doing anything different? Are you hearing anything different from your tenants? Are they a different type of tenant? Are they looking for different things? What's going on there? Now, these are apartment tenants, so it's different than single family home tenants, but I think we'd like to know.
Yeah. So we work mostly with B and C class, so working class apartments, kind of middle of the road apartments. We don't buy in the worst areas or really nice, brand new areas, but we do buy in these growth markets. And, we're seeing in general, we do see new people moving in. We see people moving out. There is a lot of movement. It's interesting with apartments. There's so much movement in general. The average person stays somewhere between a year and a year and a half. So they really usually don't stay too long. Some people stay for years, but they don't actually stay that long. So as far as specific stories, during COVID, we were seeing some people saying, hey, I can't pay rent. We've been able to go in the markets that we're in and basically apply on their behalf and get some of that money. So it actually really hasn't affected us negatively as far as some of the COVID stuff. But for the most part, people have paid. They've paid mostly on time. We've had pretty good results. We haven't seen directly as much of, okay, in this particular apartment, we're typically running 90 to 99% occupied. So it's kind of hard to see on any specific, when you have over 200 units in one place, it's hard to know exactly what each person's story. It'd be nice to do a survey though. I'd be, hey, Why are you moving and why are you leaving? And that would be a good idea. So
what's happening with the marketplace for apartments like yours? Is it tighter or looser? And then what's happening with the financing? Financing these bigger deals, is it easier? Is it tougher? Are the rates lower, higher? They're lower, of course, but just give us a perspective on financing.
Yeah, so it's interesting. During COVID, we were actually really concerned because
we're still during COVID technically.
Yeah, we're still during COVID, but I guess during the few months where everyone, I say during COVID, there was a couple of months in there, nobody knew what was happening. There were videos coming around from China where people were, falling over in the store and they're dying. And so we just had no idea what this was. So there were a few months, I would say, from in 2020, there was a few months where it was hard to get a loan. There really wasn't much stuff being bought and sold. Things were very shut down. We came out of that, and then there was all this pent-up demand, and people are buying. We still see it's very, very competitive to find great deals. And, you have to look at a lot of, in a normal market, you have to look at a lot of deals to find good deals. But I think in general, when we're talking about inflation and we're talking about growth, we're talking about whether interest rates go up or they stay low, I still think multifamily is a great place to be because rents typically will rise with inflation. It's not always a one for one, but generally income property, it generally rises with inflation. So if the cost of ownership goes up, meaning inflation rates go up, I think it's favorable to own apartments because over the long term, it lags a little bit sometimes, but you'll generally have a pretty close to inflation, hedge kind of built in there. But yeah, so I think in general, apartments, we're seeing opportunities in certain markets. A lot of it though is different than single family, where being an insider, when you have 5 large apartment buildings in one particular market, the brokers come to you, and it's a different way of doing business versus single family. I guess it's similar to wholesaling, where there's a lot of off market stuff that's sold, but it's a very unique way that we kind of get access to great deals, and we try to help find solutions for people that want to sell.
Sure. Yeah. So how about the financing? Are the banks pretty loose or are they difficult? And, of course, that's a compared to what question, because you got to give us a comparison, right?
Right. So right now, I would say in general, one way that we really tell how financing is when bridge debt is available. So private lending from banks and institutions is available. Now that some of that had really tightened up, of course, during those few months I mentioned during COVID, and even after that, people were much more cautious. So we'd have to raise more money to help cover repair costs and some of the upgrades that we do when we go in and we hold these properties for 5 years, that kind of thing. But we're finding right now there are a lot of great options when it comes to bridge debt or private debt that's 2, 3, 4, 5-year debt, and it's potentially extendable at a very low rate for a long period of time, which I think is just really fascinating, right? That we kind of generally, you and I think we think inflation, we don't know exactly what it is, but is it 5, 6, 7, 10? There's some figures that say as high as 14% right now, but you can get longer term debt for 3, 3.5, or even lower percentage points than that.
That's all part of the financial repression and the way they're screwing seniors.
Yeah.
But it benefits a lot of people. It's a wealth transfer. And I hope everybody listening is taking advantage of it, because that's what we've been trying to teach you. Borrow at negative interest rates, get inflation-induced debt destruction. It's a phenomenal opportunity.
Yeah. Yeah. And that's the thing too. A lot of people are afraid of debt, but it's just like, everybody listening, and of course, there's no specific financial advice for anybody, but the idea of taking out debt at low rates, even personal lines of credit or HELOCs or other things, and being able to find a higher return, or even something that just has a hedge against inflation, it's huge, because you're basically locking in this really low, you get this arbitrage between the two, which is incredible.
Yeah, it really is. Well, Bronson, any questions I haven't asked you, anything you want to share, whatever it is?
Yeah. So, no, I think we talked about a lot of great stuff. I like I said, I've done single family, I've done multifamily. My expertise really is in multifamily. I help wealthy professionals to find ways to save money on taxes, lower their tax basis, as well as get pretty solid returns over time. So that's really our business. And then we do these events that we've done a couple of them together. We get a panel together and talk about inflation. And so I love connecting with folks about inflation and just learning more about the financial picture, not just real estate, right? Because there's a lot of people that are real estate people, but they can get totally, in 2008, if you weren't paying attention, then there were a lot of things that happened that really affected. So I love that you are adding so much value, Jason, with really looking at the broader economic picture and not just looking only at real estate, right? You're looking at everything, wealth growth, wealth transfer, and you're putting all the pieces together. So just want to honor and appreciate you in that. So.
Yeah. Hey, thank you very much. And the pleasure is mine. It's been really enjoyable being on a couple of your panels with some really bright people who are definitely in the know. So I appreciate the opportunity and appreciate you having me. Bronson, give out your website.
Awesome. Yeah, my website is bronsonequity.com. I've got this special report. It's 24 color pages with some charts and graphs, and just really talks about the single best investing strategy during or after pandemic, about inflation, about the benefits of multifamily investing and real estate and other assets in general. So we can download that for free at bronsonequity.com.
Excellent. Bronson, thanks so much.
It's great. Thanks, Jason.
As an income property investor, imagine being able to tap into a nationwide network, actually a worldwide network, of investors who share your same challenges and successes. Imagine being able to leverage the experience of experts and learn from their achievements and their mistakes. The Empowered Investor Inner Circle is an exclusive community of like-minded and successful investors who help each other invest smarter and avoid common setbacks and pitfalls. Join us today and take your portfolio to the next level. Level up and learn from the mistakes of others. Level up and effectively self-manage your portfolio. Level up and increase your peace of mind and your profits. Level up and gain greater control.
When you join the Empowered Investor Inner Circle, you are joining a network of accomplished, experienced, and knowledgeable investors. Investors who will help you take control of your investments while saving you time and money. Managing a portfolio of income properties in a diverse range of markets across America has never been easier. With technology, almost every aspect of income property investing can be done from the comfort of your own home. Join the Empowered Investor Inner Circle for monthly live training sessions with Jason Hartman and special guests to discuss which investment strategies will work the best with your unique life situation and portfolio. Get regular real estate updates and articles so you're in the know and up to date with what's happening in the world of income properties. You will also receive inside access to Jason and his team of investment counselors who will quickly answer any of your questions. Access our Rolodex of vetted resources, including property managers, contractors, plumbers, and electricians, so you know you're getting someone who does high-quality work. Act now and we'll include 1 free year of access to Property Tracker, a web-based program that will help you manage your income, expenses, legal documents, contracts, and all contacts associated with administering income properties nationwide. A 1-year subscription to Property Tracker costs $347 per year, but if you sign up for the Empowered Investor Inner Circle today, you will receive 1 year of Property Tracker access for free. Don't let this unique opportunity pass you by. Join the Empowered Investor Inner Circle today.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.